me ask you this. Why are you watching this presentation, and why is tax-efficient investing so important to you? You see, we already know that taxes can be a highly complex topic, and while you probably understand some of what we're going to talk about today, there's a lot you can do to be tax smart about your investments that might actually surprise you. And one of our planners would be happy to discuss how to integrate tax-efficient strategies into your portfolio. Now let's go back to the question of why is it important? Well, it's important because of your future and your family's future. Thinking about how taxes affect your investments now can help make sure you have the wealth you want in the future. You see, that's something everyone should care about, no matter how much you make today. You want to be sure you have what you need tomorrow. And that's why it's important to think about after tax when it comes to investing. So let's look at taxes, the good and the bad. You see, we know that taxation is the way the government funds the things they provide in our society: highways and parks, police and the military, education and health, even taxes for specific services like Social Security and Medicare. Whether it's federal taxes or state taxes or even local taxes, the rates are always changing. For example, historically, the highest marginal personal federal income tax rate was in 1944 and 1945, coming out of the Second World War. It was 94%. Well, 50 years later, in 1995, it was 39.6%. Now, of course, those were different times, and that's just the highest rate. And there are many other variables that affect how much taxes a person pays. But it's just an example of how much rates can change. Current rates are below the long-term average, but we shouldn't feel complacent about that continuing. We have a progressive tax system here in the United States. That means the more money you earn, the higher the tax rate. Back in the 1950s, there were 24 different tax brackets compared to the 7 we have today. Analysis from taxfoundation.org found that Americans as a whole spend more on taxes than on food, clothing, and housing combined. Now, I don't know about you, but that actually kind of shocked me. The fact is that high earners pay more tax, with the top 20% of earners paying around 69% of all money that's collected by the federal government. But with all the different ideas about increasing taxes on long-term capital gains and qualified dividend income out there, it's unclear what's going to happen next. Taxes are always a hot topic on a federal, state, and local level, and what happens in Washington, D.C. is clearly uncertain. But one thing that is certain is that taxes can and will change all the time, and not always for the better. Let's delve more into taxes on a federal level. Every type of income is taxed by the federal government. But the good news is that you also get to have deductions that lower the taxes that you pay. There's a standard deduction, which varies from $12,950 to $25,900 in 2022, depending on whether you file as an individual or jointly as a married couple or something else. Or you can itemize your deductions, which allow you to add up actual deductible expenses and use that number. For some people, it's better to itemize their deductions because it will add up to more than their standard deduction. And if that's you, be sure to keep track of all your qualified expenses throughout the year, such as property taxes you paid or medical expenses and charitable donations, because you will need to support your claims. Now, as I mentioned, the federal government taxes your income, but there are different tax rates on different types of income. And the details I'll be sharing are good background information that can help you make tax-efficient investing decisions. Firstly, there's ordinary income. That's any income, such as wages, bonuses, and royalties. It's taxable at ordinary rates. When you're looking at how much you'll be taxed on ordinary income, there are 2 rates to know about: your marginal tax rate and your effective tax rate. And here's an example to help explain what they are. Let's say your taxable ordinary income in 2022 as a single filer was $300,000. Well, that puts you in the 35% tax bracket, which is your marginal tax rate. However, not all of your $300,000 is taxed at 35%. You'll pay different percentages depending on how many of the tax brackets your income goes through. That's part of the progressive tax system I mentioned earlier. Here, let me show you an example. On that $300,000, you'll actually be taxed at 10% of the first $10,275 you make, so that's $1,027. 12% of the next part of your earnings up to $41,775, so that's $3,780. 22% of the part of your earnings up to $89,075, so that's $10,406. 24% of the part of your earnings up to $170,050, so that's $19,434. 32% of the part of your earnings up to $215,950, so that's $14,688, and 35% of everything else, so that's $29,417. If you take the standard deduction of $12,950, your taxable income is reduced by that amount and your net tax liability is $74,220. Now, divide that number by your income of $300,000 and you get your effective tax rate of 24.7%. Another type of income is investment income, like from the sale of stocks or bonds, mutual funds, or ETFs. That's what's really key to our discussion today. You pay a capital gains tax on that income, and the tax rates depend on whether it's classified as a short-term or long-term capital gain. If you only held the asset for a year or less, any gains from selling it are classified as short-term and are taxed as ordinary income. So whatever your marginal ordinary income rate is, that's your rate for the short-term gain. If the investment was owned for over a year by the time you sell it, it's classified as a long-term capital gain, and it gets a more favorable tax rate. You'll be taxed 0, 15, or 20% depending on your overall taxable income that year. If you're a single filer and make up to $41,675 in 2022, or you're married and file taxes jointly and make up to $83,350, you may not even pay any tax on long-term capital gains. You'll notice that the taxable income range to qualify for the 15% tax rate is really big, so not surprisingly, most of us are taxed at the 15% rate. Finally, let's look at dividend income. That's money given to shareholders of certain stocks, usually on a quarterly or annual basis. It's part of the profits the company makes during that time, and the company shares it with the stockholders. After all, as a shareholder, you are essentially an owner of the company. The exact tax rate you pay on dividends will depend on whether it's qualified or unqualified. Dividends have to meet certain criteria set by the IRS to be classified as qualified, such as the kind of company paying the dividend and how long the shares have been held. The main benefit of qualified dividends is, yes, you guessed it, the dividend is taxed at a lower rate. An unqualified dividend that doesn't meet the IRS's requirements is taxed as ordinary income, like a salary. A qualified dividend is taxed at the long-term capital gains rate we just discussed. So that's either 0 or 15 or 20%, depending on your overall income. Now you might be wondering why all the different rates? Why do some types of income seem to be favored over others, like long-term over short-term or capital gains over ordinary income? One reason many people give is that long-term investments stimulate economic growth. So the government wants to encourage that type of behavior. And this friction, this difference in tax rates, is one of the reasons our financial planners like to focus on the tax consequences of an investing strategy. Because there are different rates for different investment income, there's plenty of flexibility in how you can be tax smart in your investing. Tax-efficient investing is an area that is often neglected when it comes to a wealth management strategy, but we really shouldn't forget how important it is. Tax-smart investing, in combination with other strategies a financial planner can help you with, can make a big difference.